Think about the world's richest people. What's the first thing that comes to mind? We often assume their wealth comes from winning the lottery, being born into a historic dynasty, or just getting lucky. But here's a profound misconception. The great fortunes of America's billionaires don't come from passive inheritance. The research tells us that their wealth is overwhelmingly self-made, built from the businesses they founded and helped grow. In fact, if you look at the Forbes or Bloomberg billionaire lists, the names of the old industrialist dynasties like Rockefeller and Astor are conspicuously absent. The real secret isn't some complex financial formula. It's a fundamental difference in behavior and psychological perspective. While most of us see money as a math problem, a resource to be earned, budgeted, and spent, the truly wealthy see it as a dynamic tool for creation and leverage. This isn't about what you know, it's about how you behave. In this video, we're going to pull back the curtain on this great financial divide and explore the three core pillars that underpin lasting wealth, the psychological foundations that enable long-term thinking, a strategic playbook for investing that goes far beyond the traditional model, and the perpetual machine of preservation that ensures wealth endures for generations. Let's start with a classic experiment, the 1972 Stanford marshmallow test. You might have seen it. A child is given a marshmallow and told that if they can resist eating it for a short time, they'll get a second one. The kids who could wait, who showed what we call delayed gratification, went on to have better life outcomes. This isn't just a cute experiment, it's a powerful metaphor for financial success. The ultra-rich understand that the ability to resist an immediate reward, the marshmallow of a new luxury item or an overpriced daily coffee, is the key to building future wealth. They make a difficult, even painful, decision to say no repeatedly in favor of a compelling, long-term goal, whether that's early retirement or funding their child's education. For many people, this discipline is a challenge because they don't trust that the future reward will actually materialize. This isn't a moral failing. It's a deeply human response shaped by life experience. The wealthy, however, have a different perspective. They view frugality not as a sacrifice, but as a proactive choice, the very engine that generates the capital for their investments. Think about the average person buying a car. They get a loan because they failed to plan for its eventual replacement. The wealthy person, by contrast, buys the car with cash, having set aside funds for years. When they do spend, it's deliberate. Their focus is on quality and happiness, not just a low price, because a high-quality item is often less expensive in the long run. A cornerstone of the wealthy's mindset is their preference to be owners, not just employees. Why? Because an employee's income is always capped by their salary, while a business owner's income potential is infinite. The great wealth of America's billionaires is concentrated not in idle cash or physical luxuries, but in their ownership stake in the companies they founded. This is the key to building a robust balance sheet rather than relying solely on a linear W-2 salary. The average person focuses on consumption, acquiring goods and services. The ultra-rich focus on ownership, acquiring income-producing assets like stocks, real estate, and businesses. While one path creates a slow, linear growth trajectory, the other fundamentally shifts your financial position from linear to exponential. For decades, the standard investment advice has been the 60-40 split between stocks and bonds. It's a common starting point, but it's not the game the ultra-wealthy play. They play a game grounded in private markets, allocating between 44% and 59% of their net worth to alternative investments. Why? Because the public market, all the publicly traded stocks you hear about, represents less than 1% of all businesses. They expand their universe to include private equity, venture capital, private real estate, and collectibles like fine art and rare wine. This strategy is supported by performance data, which shows that private equity tends to outperform public markets due to lower volatility. The secret is a simple trade-off: liquidity. Public markets offer instant liquidity, but private markets reward those who are willing to lock up their capital for extended periods allowing companies to grow without the distraction of daily trading. For them, true diversification isn't just owning a variety of stocks, it's about non-correlation. It means holding assets that behave differently in different market environments. A portfolio of only tech stocks isn't diversified, it's concentrated. A portfolio that also includes a stake in a professional sports franchise or private real estate is more resilient because these assets respond to market conditions differently, smoothing out volatility and enhancing long-term returns. A core misconception for most people is that all debt is inherently bad. And while high-interest credit card debt can lead to a financially precarious cycle, the ultra-rich understand that debt, when used strategically, can be a powerful tool. The research shows that an increase in household debt for consumption is a strong predictor of a weakening economy. The wealthy use debt not for consumption, but to acquire income-producing or appreciating assets. This is the principle of leverage, using borrowed money to amplify the potential return on an investment. For example, an investor might use a business loan to finance an expansion or a mortgage to acquire rental property. The key is that the asset's income and appreciation must exceed the cost of the loan's interest. This is a counterintuitive but crucial truth. Bad debt fuels short-term consumption, while good debt leads to long-term wealth amplification. A perfect example is the buy, borrow, die strategy. First, you buy an appreciating asset. Second, instead of selling it to get cash, which would trigger a capital gains tax, you borrow against it using the asset as collateral. This gives you liquidity without selling. Finally, upon your death, your heirs inherit the asset and, thanks to step-up and basis rules, can sell it to settle the loan without paying capital gains tax on the asset's appreciation. For high-net-worth individuals, the focus shifts from simply accumulating wealth to preserving it. Their primary concern isn't outliving their savings, but navigating the complex tax system. They recognize that effective tax planning is essential to preserving their fortune and maximizing the portion of their income available for strategic investments. To safeguard their wealth from legal judgments, creditors, or loss due to divorce, the ultra-rich utilize a sophisticated toolkit of legal structures. These include limited liability companies, or LLCs, to shield personal assets from business liabilities, and various trusts that protect inheritances from beneficiaries, creditors, and poor financial decisions. This is particularly critical given the stark reality that wealth is often fragile. Around 70% of wealthy families lose their wealth by the second generation, and 90% lose it by the third. This loss is not a coincidence. It's often caused by a failure to plan and a lack of financial literacy. This highlights that wealth accumulation and wealth preservation are two distinct games requiring entirely different skill sets. For the ultra-rich, managing a vast and complex portfolio of assets requires more than a traditional financial advisor. It demands a dedicated private organization known as a family office. This is a comprehensive, professional-grade solution that acts as a central hub, overseeing everything from day-to-day administrative tasks to complex investment decisions and strategic planning. The family office's primary objective is to manage the family's wealth and ensure its preservation and growth over generations. They provide a helicopter view of the family's entire financial and personal situation, institutionalizing financial management and education to counter the key factors of wealth, loss, lack of knowledge, and poor communication. The wealthy don't just manage their money, they create a professional entity to ensure its perpetuation. The true insight into the wealth of the ultra-rich is not found in a single, well-kept secret, but in a series of interconnected behaviors and a fundamental shift in mindset. These principles are accessible to everyone, regardless of your current financial status. Start by adopting the right mindset. Embrace delayed gratification. Prioritize long-term goals over immediate wants, and view frugality as a strategic act of capital accumulation. Shift your focus from being an employee to an owner, and actively seek opportunities to acquire income-producing assets. Learn to use debt strategically as a tool for asset acquisition, distinguishing between bad debt that fuels consumption and good debt that amplifies your financial position. The ultimate truth is that money is not just a number on a spreadsheet. It is a dynamic system driven by behavior, psychology, and strategic decision-making. The goal is not merely to accumulate more money, but to gain the freedom, control, and peace of mind that true wealth provides. If you found this video helpful, make sure to like, subscribe, and stay tuned for more tips and strategies to grow your financial knowledge.